Professional athletes manage massive cash inflows through corporate-grade investment playbooks, matching strategies utilized by elite venture capital firms or institutional family offices. Recognizing physical playing terms have strict expiration timelines, elite performers systematically transform liquid salary capital into self-sustaining long-term corporate assets. Moving completely away from passive wealth preservation systems, modern sports stars step directly into roles of founders, operators, and private equity partners to ensure earning power scales aggressively long after retirement. To protect massive capital pools from rapid inflation or market volatility, top-tier sports figures rely on sophisticated infrastructure built around fiduciary advisors, specialized venture networks, and private holding companies. Ultimate goals behind this advanced financial architecture remain completely decoupled from standard retail banking methods, focusing instead on maximum capital compounding, tax-advantaged equity stakes, and permanent cash flow pipelines. Building this long-term financial security requires deep understanding of capital preservation because traditional athletic careers provide zero revenue guarantees past physical injury boundaries. High-performing individuals construct complex asset allocation strategies immediately upon signing professional contracts, treatment of initial bonuses acting as foundational bedrock for future corporate acquisitions. Wealth networks utilize advanced trust funds, generational wealth vehicles, and multi-layer corporate formations to insulate incoming capital from aggressive litigation risks or predatory investment schemes. This level of institutional preparation allows modern athletes to function as sovereign economic entities, leveraging current cultural dominance to capture permanent market shares across diverse global business sectors before physical athletic performance experiences natural age-related declines. Venture capital syndication, and early-stage technology ecosystems. Significant shifts in modern athlete wealth management involve aggressive entry into early-stage venture capital and private equity syndicates. Rather than acting as simple brand ambassadors receiving flat fees to promote existing technology startups, elite athletes demand direct equity allocation at seed or Series A valuation levels. Many high-earning superstars establish independent institutional venture capital funds staffed by veteran Wall Street analysts or Silicon Valley investment operators, leading multi-million-dollar funding rounds across high-growth industries. Athletes target specific sectors where personal branding acts as immediate operational accelerators, prioritizing business models in digital media, sports-adjacent consumer technology, or health and wellness platforms. When elite athletes join startup capitalization tables, they provide immediate gateways to global marketing syndication and viral consumer adoption, significantly reducing customer acquisition costs while driving enterprise value upward. This venture capital execution depends heavily on understanding modern consumer psychology because technology companies require massive, sustained public attention to achieve profitable public offerings. Athletes systematically leverage massive social media distributions to accelerate product adoption cycles, transforming personal followers into direct software subscribers, application users, or hardware purchasers within hours of investment announcements. This operational synergy turns traditional passive investing into active growth engineering, granting athletes unique bargaining positions when negotiating equity percentages against traditional institutional venture funds. Over long valuation cycles, early-stage tech investments yield exponential capital multiplication, turning initial playing salaries into massive ownership shares inside future corporate tech giants, blue-chip real estate portfolios, and commercial infrastructure. While venture capital offers high-upside equity growth, professional athletes anchor family, holding companies with massive allocations into institutional-grade commercial real estate. Real estate serves as ultimate defensive foundations within athletic wealth networks, generating predictable tax-sheltered monthly cash flow while providing permanent shields against macroeconomic downturns. Rather than speculating on luxury residential properties, modern athletes pool capital into sophisticated real estate investment trusts or private equity firms to acquire primary commercial infrastructure. Primary real estate targets for athletic capital include large-scale multifamily residential complexes across fast-growing metropolitan areas, Class A commercial office parks secured by long-term corporate leases, industrial distribution hubs, and e-commerce fulfillment centers sitting at centers of global supply chain grids. Commercial real estate acquisition provides incredible tax advantages, including accelerated depreciation models and interest deductions that effectively minimize overall personal income tax liabilities. Athletes utilize specialized real estate syndicates to acquire high-yield logistics centers, capitalizing on expanding global e-commerce supply chains by collecting consistent commercial rent from multinational tenants. This focus on premium, income-producing brick-and-mortar assets ensures that even during massive stock market corrections or economic recessions, athlete portfolios continue generating liquid capital. This continuous cash generation funds ongoing lifestyle requirements without forcing liquidation of long-term stock investments, preserving core principal wealth across multi-decade timelines. Ownership of sports franchises and emerging media rights networks. In historic reversals of traditional sports hierarchies, professional athletes increasingly transition from playing personnel into team owners or operators. Recent sweeping changes in league bylaws across major international sports associations enable active or retired players to acquire minority or majority ownership stakes in professional sports franchises. This strategy allows athletes to invest in exact industries they understand best, capitalizing on massive uncorrelated valuation growth that professional sports teams consistently deliver. Athletes target sports franchises because they represent scarce blue-chip assets protected by closed league systems with zero risk of downward economic relegation. These investments are further supercharged by multi-billion-dollar global media rights contracts secured by long-duration television or streaming networks, guaranteeing stable long-term corporate revenues across sports leagues. Investing directly inside professional sports leagues provides athletes unmatched inside knowledge regarding media consumption shifts, stadium naming rights negotiations, and international sponsorship expansions. By holding direct governance seats on franchise boards, athletes influence long-term structural decisions, pushing organizations toward aggressive digital media expansion, global brand licensing, and data-driven ticket optimization models. This institutional ownership model converts athletic expertise directly into corporate leadership, allowing sports stars to pocket massive franchise appreciation profits driven by endless corporate bidding wars over live sports programming rights globally, direct-to-consumer brand incubation, and operational product lines. Definitive pinnacles of modern athletic wealth generation rely on absolute rejection of traditional endorsement models in favor of proprietary brand incubation. Instead of renting out personal likenesses to outside consumer packaged goods companies for minor percentages of sales, athletes fund, launch, and scale independent corporate product lines from scratch. Utilizing massive direct-to-consumer digital media reach, superstars launch lifestyle apparel lines, premium beverage companies, or functional nutrition brands. Owning 100% of intellectual property and manufacturing infrastructure allows athletes to avoid sharing premium retail margins with traditional wholesale middlemen or corporate parent companies. Direct operational control allows family offices to scale businesses into attractive acquisition targets for multinational conglomerates, executing massive liquidity events establishing true generational wealth. Brand incubation strategies rely heavily on vertical integration, meaning athletes control everything from raw material sourcing and manufacturing contracts to digital e-commerce storefronts and localized fulfillment centers. Eliminating traditional retail middlemen ensures maximum profit preservation, allowing proprietary brands to outcompete established market rivals on pricing while maintaining superior financial margins. When corporate giants execute multi-million-dollar buyouts to acquire these fast-growing athlete brands, initiating founders secure massive cash payouts completely independent of playing statistics, cementing permanent financial sovereignty through successful corporate execution. Building highly strategic approaches to capturing global attention, securing consistent cash flow pipelines, and scaling monetization systems remains ultimate secrets to surviving in modern hyper-competitive entertainment economies. If you want to keep discovering how elite sports franchises, corporate entertainment networks, and top-tier digital creators build, protect, and scale wealth networks across global attention grids, make sure to hit like button on this video and subscribe to the channel right now so you never miss our next deep dive into business models of world's most lucrative industries.